Welcome to the Daily Exchange. I'm here with Georgie, my man Georgie. We're going to talk about the future of cryptocurrencies, protocols, stablecoins, privacy coins, and the trade-offs involved. While the market seems to be going back up, we'll see you guys right after this. The Daily Exchange. Guys, welcome back. I'm here with Georgie, the man himself, George Samman. He's doing a lot of work. If you want to check out George's background, check out semantics.com, salmonantics.com. You can see the website right there.
Right there.
Georgie, we caught up in New York at Consensus. We've been having a lot of chats. You've been doing a lot of work right now on protocols, stablecoins, and all sorts of things. And we're going to get into that, and we want to talk a lot about all this kind of stuff. Let's just start by, do you want to have a quick analysis of the market and where we're sort of at and where you're sort of seeing things?
Yeah, so it's interesting where we are right now. Like, obviously, there's a lot of doom and gloom in the air. People are kind of like questioning a lot of the stuff that they thought not too long ago and wondering if any of it makes sense, if anything's ever going to come back. So the way I would compare it is in the traditional markets from like 2009 until like very recently, you had quantitative easing, and there was these things called taper tantrums that would happen all the time, which meant that anytime it seemed like a government or a central bank was going to stop the easy flow of money, the market rioted, and it kind of just like stopped in its tracks because people thought that equities weren't going to be supported and there wasn't going to be all this liquidity that came into the market. What you've seen here is like liquidity leave the market because of a lot of doubt. And what I would call it is something like a token tantrum. People are kind of starting to think to themselves, do tokens make sense? Why are all these tokens out there? These protocols that are being built, all of these different things. What is this technology? Do I even know what I just invested in? How is this stuff going to work? Will it work? Why do we need all these tokens in the ecosystem? Why not just native tokens from some of the big protocols? How did we get to where we are? And what happens generally, like in liquidity crises and bear markets, is it's almost like the same thing as like what you see with like the whole entire Bitcoin movement. It's this lack of trust. Like decentralization gets rid of like trust in a lot of ways, but like belief and trust are missing in the market now. And as a result of that, you're getting this liquidity cut back in the markets because people aren't sure of what's happening anymore. And I think like liquidity isn't just about money flowing in, it's about how money flows out and disbelief and group disbelief. So people are just moving and to the floodgates at the same time, and money's leaving the market. And as a result of that, you have a lot of projects that raised in ETH, because ETH has been the main conduit to it, who are now in a position where not too long ago, they were looking at ETH at 1,200 and thinking to themselves, God, I have so much runway. And as the prices dropped, markets always surprise you to the downside, to the upside. People didn't think it would go this low, and then it keeps going lower and lower. And now the runway has shrunk tremendously from years to maybe months for some of these projects. You don't know. So they're liquidating at lows because they're worried that everything's going to go to zero. So you've been seeing that generally the price of Bitcoin and ETH kind of stay in the same range. Yeah. It's uncoupled a bit because all the projects that have raised in ETH are just starting to liquidate. And that's kind of where we are.
And we saw it yesterday. Like we saw a massive sell-off. I think yesterday's show was the meltdown of Ethereum. Apologies if I freaked anyone out. Joel, did you get freaked out yesterday?
Yeah, a little bit.
No, Joel didn't get freaked out. Show us some, Joel, bring us up the numbers here just to give, so Georgie can talk through this as well with me. You can see the numbers in terms of where we're at. You can see Bitcoin's at 6,000, I'd say 200. It's sort of stable, you'd say. Ethereum has definitely gone up at 6%. Ethereum Classic up 8.79 and EOS up 9%. So you've got that re-rally of the alts coming back into the market because everyone realized, potentially we're not going to zero, right?
Yeah, well that, and I wouldn't get too excited about this, but if you look at some of the numbers, like the amount of shorts in the market right now are at record highs. And generally the price of Bitcoin, in order for shorts to be right, the price of Bitcoin needs to fall to a certain level, and it's kind of been stable. And everyone and their dog has gotten on the short side of the trade. So if anything, you'll start to get a little liquidation in the shorts, which would give you maybe a relief rally. So really what you need to see is how the market reacts as people reposition themselves and some of the shorts come out of the market. But it's been due. I mean, you always get some kind of a reversion to the mean, even in massive bear markets. So a rally is due at some point, whether it's now or not. It's hard to tell, but I would say that it's been a classic bear attack, and there's been a lot of good news, but the market continues to go down. It's the summer as well, so there is less liquidity in the market, and it's very easy to move the markets when there's less liquidity in them. But the way I'm looking at it is, I think come September, when people are back at work and whatever, we have a lot of big decisions to come up. The ETF decision is September 30th. So I would probably think that there would be a rally into that at the very least, because they didn't reject it. They said we need to think about it more, and there's been lots of evidence presented that this case is a better case than what the Winklevoss twins did, and it makes sense for it. Not only that, though, there's I saw something on CoinDesk, there's like 16 other ETF decisions between now and the end of the year.
Yeah.
So
there's a whole list of them.
There's a whole list of them. So there is going to be a lot of headline news that can actually move the price tremendously, and there'll be a lot of people positioning themselves ahead of that as well, I think.
So let's talk about protocols. Let's open up the tin. And you talk a lot about trade-offs, Georgie.
Yeah.
Tell us about that. We've got the whiteboard out today, guys. This is going to be a new dimension. Welcome the whiteboard of wonder.
Yeah, so I think this goes back to kind of like the state of the market, right? Yeah. And I think it's kind of pertinent.
I want to start by just saying, let's just start by with protocols. Everyone's, wondering where are we going? What's the protocol of choice?
Yes.
And I just want to open with just a basic question like that is, do you have a view on which protocol is going to win or what the end state of protocols would be like?
I think that if anyone actually knew that at this point in time, they would probably be lying. I say that you can follow the money in some senses, and what I mean by that is the protocols that will probably win will be the ones that can solve for some of the trade-offs that we'll talk about.
Okay.
But the protocols that will also win will be the ones that the developers are most building on. And right now you have a few that have big, rich ecosystems, mainly Ethereum and Bitcoin, and others have raised all sorts of money and now are trying to build big developer ecosystems around them. But we'll see how that goes over time. But I'd also go back to something I said before, or alluded to anyway, is this whole question and the reason why the market is in such a place of disbelief right now is it's around usability. And people, the market got way ahead of itself, right? Because there was all this amazing technology, and everyone knows that at some point in the future, that now that this technology has a big use case, whether it's the crypto side or it's the blockchain side, and all sorts of people from all walks of life are now investing into the space because they know that they see value in it. But like everything, the excitement is way ahead of where the technology is, right? So when we're talking about the future of protocols, I think we need to start thinking about where we are now and how you can think about the protocols that are going to win. So to me, that means a couple of things. What are all of the people that are trying to build on this stuff trying to solve for? Or what do they want? What's on their wish list, right?
And let's walk us through. You've got an interesting diagram, Georgie. Do you want to unveil that and sort of talk everyone through?
Yeah, I'll talk through that.
And when someone's choosing a protocol, I'm a developer and I'm choosing to develop on something, what do you think the trade-offs that they are going sort of through there?
Yeah, so there's a good mental model that I like to use on a lot of things, and it's called an impossible trilemma. And it's a triangle where you can only have 2 of 3 at any time when you're trying to build something out or work something out, right? And we'll go through this with not just the protocols, but with the stablecoins as well, because it exists there as well. So essentially, the things that people want now are to be as decentralized as possible.
Okay, so decentralization,
privacy, and scalability. Those 3 things do not exist in any one protocol right now that is anywhere near where it needs to be or promises to be what it is. So that's another reason why you see all these hot, flashy protocols that are promising all these things now, and you have these influencers who get behind them, and a lot of times I don't think they understand the tech, or they're believing a team that they're going to be able to overcome some things that have been pretty insurmountable up to now, which maybe over time will be able to be fixed.
And let's nail this down. So decentralization.
So yeah, I could show it here, right? So I'll put up this chart right here, right? So you have on it 3 sides. One side is decentralization. And on the decentralization side, you have from fully open network to a closed system, right? And so that means that, like, for example, in theory with Bitcoin or Ethereum, anybody can come onto the network at any time and join the system. Anyone could be a node, anyone could be a miner.
Gotcha.
We know that's not true now because it's become a little centralized, but it has tended in the past to be, and it can be at some point again. Over here you have consistency, which is that all the nodes get to see all the information at the same time, so everyone's getting the same record of the ledger and able to look at it and whatnot. And then at the top, you have scalability, which is, you know, how many transactions per second can you do? But it goes more than that. It goes into high throughput, which is transactions, capacity, which is high capacity, which is the broadband, how much information could come through the broadband, right? And then low latency, the speed of it. So right now, for example,
does this also talk about energy cost? Or usage?
It doesn't exactly talk about that at all.
Let's park that for now.
Okay. But like, so you can only have 2 of 3, right?
So we got decentralization, scalability, consistency,
right.
And this is kind of privacy in a sense as well.
No, this isn't privacy. This is more about how, like with a fully decentralized network, generally the reason why you can't get scalability is because you get consistency, meaning that all the nodes get to see all the information and it flows to all of them. So that slows down the scalability of the network, right? So for example, in that case, you have like Bitcoin and Ethereum down here, right?
So where would you plot? So you're saying they are decentralized.
They're
consistent,
but they're not scalable.
And where are they more decentralized or more consistent, or sort of they're a bit of both?
Well, let's put it like right over there somewhere, right? Okay. Like pretty about as decentralized as anything is, and consistent because you can run a full node and get the information if you want to.
Ethereum, I guess, is a bit more consistent.
Ethereum is better in it's probably better in a little bit of each respect, but not by much. I mean, they're pretty. You could put them in the same category, maybe a little different, but not really. So like if you have something that's really scalable and really consistent, you wouldn't have decentralization. So you can use this as a slide rule, right? The less decentralized you are, the more scalable and the more consistent you can be. So for example, a lot of these private blockchains, they're not decentralized. They're in fact, they're pretty centralized, and they achieve high scalability and high consistency, which is a use case that a lot of people want, but they are not decentralized.
If you were to, so when people fork Ethereum, so CBA is forking Ethereum to do a private blockchain with their bond with the World Bank. Would that be then go over to here?
Yes, it would, because you could achieve certain things by being private that you can't achieve in a decentralized way. And also, this goes to the privacy question as well. When you're very decentralized, you're not private at all. So that's another trade-off that we can talk about after as well. And so that's how you look at this, right? So you move it around and you can see things and like there's always going to be trade-offs. And
so where maybe just plot a few more. So we've got EOS, for example. Where would you plot EOS?
It would be like somewhere over. It's not very decentralized, so somewhere over here, right? So Hashgraph is the same. So anything that has delegated proof of stake in general, you're giving up decentralization in a lot of ways because you have a certain amount of people who are coming to consensus, and there's a small amount of them, and they're kind of known and whatnot. Gotcha. So that's what I'd say there.
And what about, say, Ripple?
Ripple is scalable, consistent, and not decentralized at all. It's pretty much fully centralized. So Ripple is like right over here.
Wow. So it's very consistent.
Yeah.
Did you say it's scalable?
Yeah. I mean, according to the testing and everything that they're doing, they get pretty good scale with Ripple. Okay. Yeah.
And so Hashgraph, you're saying, is not so much decentralized?
I put Hashgraph close to EOS, to be honest with you. Of course, they achieve their consensus and what they're doing, their tech in different ways, but they both use delegated proof of stake, which allows them to achieve a scalability and a consistency that's very different than Bitcoin or Ethereum.
So what about, are there any that are very scalable and decentralized, but not so consistent?
Scalable and decentralized, but not so consistent. There are some, but you see, when you do that, basically, to get rid of the consistency, sometimes what you do is you don't give someone the whole entire blockchain, for example. You give them just a piece of it or whatnot. There probably are a few examples. Nothing's coming to my head at the moment right now.
Right. So people have tended towards scalability. The recent trend of protocols has been towards more scalability and consistency and away from decentralization.
Yes.
Okay.
Yeah.
And if you're a developer right now, what do you think developers, they're looking at this triangle and trying to make an assessment of this. What do you think they're thinking right now?
So it's an interesting question because you want to get performance as much as you can because that's what brings usability to blockchains. But if you talk to a lot of the people who have come into the space, the developers and whatnot, the reason why they're here is for this. They believe in decentralization, and that's why they're building on Bitcoin. That's why they're building on Ethereum. That's why these have rich communities of people. Decentralization really matters, and the ability to create governance structures that haven't existed before, and to get away from the Googles and the Facebooks of the world. And
and another thing, obviously, about decentralization is it allows like persistence. It's very hard to shut down a decentralized system. Right?
Yes.
So they're ensuring that their code and their system carries on for a very, very long time, I'm assuming.
Yes.
And do you think they're fully aware of this trade-offs that they're making?
Yeah, they definitely are because this isn't something that I've made up. This is something that it has been done in different versions for different pieces of how you're thinking about the technology and how you're building stuff out. And this is the kind of stuff that people have done since probably like mid 2015, 2016, when you had the first couple instances of decentralized systems, and then people started to realize, hey, wait, well, we can't achieve all these, and it's not going to happen anytime soon. If we want to get to them, we have to build other things. So people have done that.
So with these trade-offs and with these protocols, and there's a lot of them now. They've really exploded, and there's even more coming onto the market. Do you think there's too many?
Yeah, I do, but I don't think that's a bad thing right now because we're still in that kind of place of like searching for what is and what isn't going to work. Obviously, most of them will die, like in every other space, I think. But the ones that do work and are able to achieve this holy trinity at some point, in some way, will be the ones that survive. And you have like, for example, Ethereum's working on scalability and privacy right now, right? And it's slower than people want, but with all the devs that they have building stuff and the committed people that are working on the platform, I think those problems have a good chance to be solved. I won't say that they're going to be solved because it's really, really hard, especially when you have a legacy platform. Yeah. So, I think the future is really going to lie in which platform's able to achieve most of these things in a decentralized way. Because, the way I always think about things is in history you veer towards decentralized systems and centralized systems, and we're going back towards decentralization again now. It's pretty clear. Whether it's like the small communities that are being built around the tokenized systems that are happening, the nation state itself is in question now more than it has been since the beginning of nation states being reformed in the Renaissance. And you have like a lot of sovereignty and governance that a blockchain gives you that allows for people who live in geographically distant places to be able to come to agreement and build things together without needing to know each other or trust each other. And that's a big barrier that we haven't been able to get through for quite a long time. So me...
So with these, these obviously these different protocols, a lot of them were, I guess, really sped up by this ICO and this new token economy.
Yep.
What's your view of the future of that, George?
So I think depending on if you did proper treasury management or not, and you have a fair amount of cash to build.
Just before you know, what when you say treasury management, just walk us through what
your
view is on that.
It's kind of what I was talking about before when I was talking about why Ethereum has lagged and dipped so much. It's because a lot of these companies didn't sell when they should have right after the raise, and they held the ETH through a down cycle that's put them in a jeopardy now of not being able to complete their projects or left them in a very weak cash position, and they probably won't be able to fulfill their mission in a lot of cases. So the companies that did and have large amounts of capital probably will be able to build out a lot of the stuff here that we're talking about. Some of them will fail though. I mean, the one thing you have to understand, and the brightest minds of the space are all working on this thing called consensus and how you get that in decentralized systems. It's really hard to solve for consensus. And people are struggling with it now. It's not exactly about a money thing or a technology thing. It's about how you can achieve it in mass scale while trying to get scalability and consistency. And it's not something that's very easy to solve. I mean, it's been around for a long time, and it wasn't just invented when it came to cryptocurrencies. I mean, it was been used in airplanes for a long time. Traffic lights use consensus to coordinate. So, you know, these aren't new problems. They're new problems on a blockchain, and they're going to take a little bit of time to solve. And we're seeing that there's lots of hiccups with a lot of people are doing. People are building some stuff off-chain, like around privacy solutions, because it's very hard to do it on-chain and get scale again, and all these other kind of things.
So say these new utility tokens on Ethereum or on other platforms. You know, do you think that can exist? Do you think they can carry on? That those economies and the people who invested in those, do you think that model is sustainable for the future? Or do you think maybe it needs to go back to people buying the native token potentially and raising with that and using that within the system?
To be honest with you, I've thought about this a lot, and I'm not sure. I'd say there's a stronger case in a lot of cases to just build on the native platform. But how do you raise money? How do you build a community for your product around that is something that I think people are thinking about. The other side to that is I do believe that some of these systems, maybe not utility tokens, but things that are trying to be stores of value in some way or mediums of exchange, can exist as a token if there's a belief in that token as something of value. So the real question comes back to is how do you create something of value? And how do you get people to transact and use that something of value that you create? In a lot of the cases that we've seen so far with utility tokens, there's not that. Like they're gateways or membership fees into like using a platform, which isn't a compelling use case for a lot of people for owning that token and using that token and having that token. And just vehicles for speculation instead of usability.
I've been kicking around this idea that potentially most projects should raise in the native token. And that should be largely incentivized to encourage whatever blockchain you're building on, for the developers to be at the benefit of basically creating more adoption and usage of that native token in order to build that protocol. And the way they benefit is by those native tokens that they've raised going up in value. Now, some of that obviously could be used for the project. Yep. I think part of it should be potentially locked up and some sort of governance voted upon when they've delivered this application. But I almost think it could be, it's almost like if you had a blockchain, potentially that's a corporation, but it's a decentralized corporation that people can come and go, hey, I want to join this corporation and build this project in the ecosystem. And they will go, yeah, okay, fine, yeah, I'll tip in some of our tokens. And people who have developed in the past will encourage more and more projects to come in that are good projects and good developers, because they want their tokens as well to go up in value. So the whole ecosystem keeps investing and growing upon itself. Almost like the native token is the share price to some extent, right? Yep. And I think the more and more people can stay within their ecosystem and keep growing, and I think that's what might happen in Bitcoin and with Ethereum. People they funded projects, early developers funded projects on their own protocol that they own in order to enhance their actual value of their token or their
100%. In fact, like Vitalik made this argument about a year or two ago, saying that like one of the problems with Ethereum and the Ethereum Foundation is that all these tokens that were raised on top of Ethereum have distracted or taken away developers from building out the core functionality that Ethereum needs to be the platform that it wants to be, which is, you know, to get privacy and scalability solved for, right? And instead, it's these guys have raised money and gone off and done these other side projects that, and it's taking developers and a lot of attention away from getting that right first before you can build the stuff on top of it and make it really good and usable and people wanting to go on that platform. So I think you're right about that. I think that's one of the major arguments for native tokens versus utility tokens. Obviously, in some cases, having a utility token probably makes sense, but overall, I think most of the tokens should be protocol tokens until at the very least, you know which protocols people are going to be built on and using, because right now you could have dApps all over the place, and dApps on EOS, dApps on Ethereum, dApps on Hashgraph, et cetera, et cetera. But if not all protocols are going to be the ones that are going to be the winners, you could have 3 or 4 ride-sharing apps, or 12 or 20 on 12 different protocols, and you're investing into things that are basically not going to be usable because no one's going to be there to use them at all. So it's like, until you know which protocols are getting the most traction and have the most amount of people building on top of them, it's still too early to really speculate on a lot of the dApps. And it's taken Ethereum, like Augur, for example, was started to be built in 2015, 2014. It just went live, a couple weeks ago. It's getting about $1 million a day and doing well, but these things take time, and that's just one dApp that is popular aside from CryptoKitties or something along those lines, right? But all this other stuff is still really speculative. So a lot of people in the space have bet on the fat protocol theory for now, which is, let's bet on the protocols, the underlying protocol that's going to be the ones that are going to use, and the winners of those will be the ones that gain the most value because they'll have the biggest networks, right? So
100%.
that's kind of where it's been. So I think it's tricky to really think about dApps yet. I think over time, though, dApps will be where a lot of the value and money comes from as well.
So you have another trade-off. Do you want to talk us through that one as well?
Well, it's just around the privacy thing, and it comes down to kind of the same thing again, because you're talking about privacy and privacy coins and stuff like that, and I'll just erase this one. Privacy is a hard one to solve as well, and this is something that I saw on Medium and makes a lot of sense to me from the standpoint of looking at privacy, and it's really around usability.
So we talk a little bit about, this is really about privacy coins, or this is just still about the protocols?
Really both.
Both.
Okay. Privacy in general. So you have usability, privacy, and scalability here, right?
Yep.
So
now walk us through each one, George. What's usability?
Usability means that with a lot of the privacy solutions, they're really hard to use because they use a lot of advanced cryptographic techniques. They're clunky. They don't work really well. You can't use them on a mobile app for the most part, stuff like that, because they're using so much compute power to solve algorithms and keep things cryptographically private, right? So that's ZK snarks, for example, would be usable and private, but not scalable as they exist now.
So it's lots and lots and lots of cryptography.
Solving proofs takes a long time.
Yep.
Yeah. Scalability and privacy could happen without usability. That is something that is interesting to think about. Not really sure that anyone has.
So where would you plot where would you plot, say, Monero on something like that?
Monero is here as well, maybe a little bit over more because it's private, fairly usable, but it's not very scalable.
Okay.
A lot of exchanges have trouble integrate with a lot of these privacy solutions. For example, exchanges have trouble integrating and building the wallets because of how complex it is, because of the way that they're built and the cryptographic nature of the wallet itself. So
Dash and Zcash and those kind of things, where would you put
Dash
those?
is probably so Dash isn't as private as people think, but Dash goes over here somewhere. Zcash Zcash has 2 blockchains, right? There's one that's exactly like the Bitcoin blockchain, and it's it's not private. So that one is more scalable and private and usable than the other one, which is the one that is the one that uses zero-knowledge proofs, and you have to pay more to use that blockchain. That one isn't very scalable at all. It doesn't have a lot of use to it, so it would go over here somewhere. In that.
And where do you think we're going with privacy coins, George? Where is the future of this?
I think privacy coins have, I don't think they're going anywhere. I think, in fact, they're one of the more important things that you want in the ecosystem. They get closer to achieving fungibility probably than Bitcoin does because of the private nature of them. So when we talk about Bitcoin, everyone always assumes, probably not anymore, if you're in the space, you would be pretty aware of this, but Bitcoin is not anonymous, it's more pseudonymous than anything. It leaks data along the way, and like you can find out a lot of information around it by tracking wallets, just by generally when things are moving through, you can see them and stuff. So privacy coins, in theory, at least the newer ones that are being using zero knowledge proofs and Monero to a large degree as well, are fairly private. There's another one called Beam, which is going to be using Mimblewimble, Grin also, and they're trying to solve for this whole entire issue of leaking data, keeping transactions private, and keeping the amount sender and receiver, so the amount sender receiver of the transaction private. And you know, that's a big deal, because if what we've seen with Bitcoin in the past is that there have been some tokens that have been worth more than other tokens. So example, back in 2014, you had the U.S. Marshall auctions, right? And people were buying those tokens above the price of Bitcoin at the time because they were seen as whitewashed, since they had gone to the feds and they were cleaned up from any past discussions around them. People were paying more for them than the ones that were actually trading on exchange.
Wow.
Yeah. So one of the things that these privacy coins are solving is for fungibility, and fungibility is super important, so that one coin equals one coin at all times and no matter what. So that, to me, is one of the more tremendous use cases around why privacy coins mean something, and will stick around.
Let's move on.
Okay.
So I guess we've talked about protocols, we've talked about privacy coins. Let's talk about stable coins. So I know you're writing a white paper right now. Do you want to tell us a bit about what's the paper about?
So the paper is pretty broad in its expanse. I mean, we go through kind of like the history of money and why money needs to be stable and how money has been destabilized over time. So, you know, that happened around the time of Bretton Woods, when money became unpegged from gold. And it's allowed fiat to free float. The value of it, you know, is determined by printing money, and you can always devalue it over time. And it's left a lot of countries in currency chaoses, pegging to dollars, unpegging to dollars, money printing in a lot of the developed nations, irresponsible fiscal use of monetary tools and whatnot. So with cryptocurrency, so with that, you know, cryptocurrency was born, and cryptocurrency itself also suffers from some of the volatility of the money systems that exist today. So people have invented stable coins, but where like, and those stable coins are supposed to help stem volatility within the monetary system of cryptocurrency, right, in one shape or form or another. But like, I'll just take a step back and talk about monetary theory, and again, another trade-off that's been made with just traditional fiat money. So you have, again, these three things. You have, and you can only have two of three. You have free capital flow, you have sovereign monetary policy, and you have a fixed exchange rate. So
should we put those up as well?
Yeah, I will. This is actually where the impossible trinity comes from. This was like one of the original ones that existed, and people have kind of used that in technology and lots of other ways. Tech people have used it comes from a different you know, a different model, but these models all exist, whether it's economics or technology.
Yeah, I remember, like, if you're talking about a tech project, you've got time,
right,
cost, and quality.
Yep.
And you can only pick up two of them.
Exactly. So, like, these models are very helpful and useful. Why I like them a lot is because they always ground you back into where you are in things. Yeah. So, with crypto and all the noise and everything that's been happening, it's really good to start thinking back again about what you can do and what you can't do, and what's available and what's not available, and what are the tools that are necessary to build things, and how can you start to solve the problems around them, right? So with a stable coin, so money, tell us what are the three things. So before we get into stable coins, I'll just talk briefly about this, which is the Mundell-Fleming trilemma, and this is kind of where currency, how central banks look at you know, how their money systems and how they can only achieve certain things around it. So you would have sovereign monetary policy here, right? You have up here a fixed exchange rate, and down here you would have what is it? Sovereign monetary policy, a fixed exchange rate, and free capital flow. Sorry. Okay.
We've got a question coming in.
So what?
We've got a question coming in,
okay.
George. Roll us the question, Joel. We'll prepare the question as we're coming. We've got a question coming in, Joel.
Okay, so I'll go through this, right? So let's talk about how this works. So in the United States, you have sovereign monetary policy. You have a central bank. They are able to do things around full employment and keeping inflation low.
Yep.
You have free capital flows. So
what does that mean?
So it means that money can go in and out of borders freely.
All right. So like in South Korea and China, you can't easily do that.
Yeah, I'll actually show you the example of China here as well. But you don't have a fixed exchange rate because the fiat dollar is the reserve currency of the world and is able to do things that other currencies can't do. The Eurozone has a fixed exchange rate. Everyone in the Eurozone uses the euro now. It has free capital flows, but it does not have sovereign monetary policy. The reason why is because each country has kind of given up a certain degree of monetary policy to the central bank of the ECB. In China, you have sovereign monetary policy and a fixed exchange rate, but you have no free capital flows. The sovereign monetary policy comes from the PBOC, which dictates everything, the People's Bank of China. They fix their exchange rate, at least they have, to the USD for quite a long time. Now it trades within a band of that, and they have restricted capital flows. And this has been well documented, particularly in the crypto space, because that's been one of the major drivers of Bitcoin over the 2015, 2016, 2017 move out of bear into back into bull. So these things.
Where's like the Australian dollar?
Would probably be somewhere around free capital flows, sovereign monetary policy.
No, it's not fixed.
Yeah, not fixed. So the reason I bring this up is because these things lead to destabilizations in other currencies. Like when one thing isn't happening, or when you're pegged to the USD and then you unpeg from it, or you're pegged to something else. You give up your own monetary policy, your own sovereignty around money, and that's really problematic for a lot of countries and whatnot. So now move this over into stablecoins and how you can think about them, right? So stablecoins actually also have trade-offs involved, and there's different types of stablecoins. I'll talk about them based off the trade-offs that I put up here, right? So let me just move out of this and into how money gets stable. So
George, just 2 seconds.
Sure.
We've got a question coming in. Roll us the question, Joel. Question we've got is, what do George and Fred think of stablecoins pegged to an existing fiat currency? Does pegging to a basket of currencies work better? Interesting question.
Yeah, so do you want me to
go ahead, you
talk
start,
about that?
George.
Sure. So I think that's a safe and easy place to start, and it's something that people know and can get their heads around, and a lot of projects are using fixed stable coins, fixed back to dollars or back to gold or something. But I think over time, what this whole entire marketplace is about, and also those are centralized solutions, and I'll get into that when I talk about some other stuff in a minute. But what you really want to do when you think about stablecoins and what the big prize is here is it's becoming or superseding fiat currencies. It's becoming basically the central bank for the internet, and in order to do that, you can't really peg to one currency, to a legacy system. So how you do that is something that a lot of companies are starting to think about, but it's still kind of early in thinking. But you do that by having some kind of central bank that could be a basket of lots of different things, including cryptocurrencies, commodities, and fiat. Or you
throw in a Big Mac in there?
Yeah, you could throw in a Big Mac. Big Mac might even be worth more than that.
An Intel processor?
Yeah, but it's a grand prize, and the winners will, it's the world of money, basically. So it's big thinking, and I think, fiat-backed is good for now. As the training wheels come off, it probably is something that goes away. But that also predicates on a bigger topic around nation states and how they'll want to control their money supplies and stuff like that. As money starts to get taken away from them, how are they going to react to that and whatnot? But
that's a major issue.
It is, and like a lot of this stuff is based around that, like the nation state and what it's capable of and incapable of going forward, and will it be able to control money going forward? And a lot of people are betting no, it won't, and that's where cryptocurrency kind of comes from, right? So how long that's going to take is a different story, though.
So thank you so much, Brenda, as well, for your question. I think George is on the money there. I think it's probably our first step. And as you say, the training wheels are going to come up. I do think there would be a basket of, it might be even digital goods. How much does a domain name cost? How much does an iPhone cost?
100%.
What are the everyday items in our everyday world? How much does it cost to stream Netflix potentially even? Imagine if that was part of it, right? Because you took what is the everyday basket of goods, I think, versus what they used to be is very different, right? We all buy a phone every 1 or 2 years, and pretty much everyone around the world does that as well.
Yeah.
So I do think that potentially that needs to change. And I can't see why a digital currency as well couldn't be part of that as well.
Well, I think, in fact, it would probably be more so because, like I said before, fiat is backed by nothing and can be printed infinitely. The one thing about digital currencies and the thought experiment around it and what it means is it has digital scarcity, right? And digital scarcity is something that has inherent value in itself because it can't be printed away. It has a fixed supply. Whether it be crypto kitties or decentralized land being bought or Bitcoin or any of these things that have fixed supplies to them. So commodities is another one, gold for example, right? That's why gold has value amongst other things and why Bitcoin is compared to digital gold a lot of times. There's no reason to think that things that are digitally scarce can't be a basket that something is back to over time.
100%.
Yeah.
So coming back, thanks so much for the question as well, guys. Keep on sending them in. Thanks, Joel, for alerting us. You were coming to stablecoins and the trade-offs.
Yeah. So
George,
okay.
do you want to talk us through your thinking on that right now?
This is stablecoins here, right? You have decentralization here. You have collateralization here. Collateralization, in case anyone isn't aware, is just what it's backed by and how much it's backed by. And then over here you have
similar to Brenda's question.
Yeah, capital. Yes, exactly. So 1-to-1 backed. You're backed 1-to-1 to a fiat currency or to gold or something like that. And then over here you have capital efficiency, and that's really how capital is being deployed within your system. And how efficient is that capital deployment? So I'll go through this. So let's talk about Tether, the most popular and talked about stablecoin, right? It is collateralized by fiat dollars, which turn into a Tether USDT. It's capital efficient because it's backed 1-to-1, but it's not decentralized. It's fully centralized. Almost all 1-to-1 backed.
So it's kind of like about here.
Yeah, they're all centralized. They give up that decentralization. You know, they have a banking account. They're known entities. The government can come and shut them down at any point.
What about, say, Haven?
Yeah, so Haven is what it would be called in terms of, so that would be called like fiat collateralized or asset backed 1-to-1 because it's not just fiat. Anything that's backed by some kind of real world asset would be in this case here for the most part. Haven is collateralized and decentralized. So Haven, it uses on-chain collateralization of cryptocurrency, Ether. Now it's moving also to EOS from what I've heard.
Yep.
But in order to collateralize it, you have to overpay the amount of ETH or EOS to collateralize something. So it could be 5-to-1 or whatever.
Yep.
But it achieves decentralization, but it's not capital efficient because you have to put up more capital than you're pegging to in order to,
and that sort of hedges the price.
It hedges the price.
Gotcha.
To a degree, or at least the volatility in it. So if it moves by more than the peg, in theory, the band around that should be able to hold it. Although we've seen in certain cases, maybe not in Haven's case, but in other cases that the band hasn't been able to hold, they've had to readjust or ask for more collateralization around that. And then the third kind is seigniorage. And seigniorage is basically like the central bank model we're talking about. So you buy shares, you sell shares when there's more supply, there's more demand on one side to get back to
increase and decrease.
To get back to equilibrium. And that is fully decentralized, capital efficient, but has absolutely no collateralization behind it at all. So that model would be something like the basis model, which is based off of Robert Sam's work around seigniorage shares. There's a couple other people working on that and whatnot. So that's really like how, so that's how you think about the stablecoin space too. So 100%. There are trade-offs in that as well. You know, over time, potentially, we might be able to solve for some of these things, but
Where do you think we're going to end up with this? Where's your sort of prediction for the future, George, of stablecoins?
Well, if you want to, so I've part of my white paper is talking to, and we put a survey together of questions that we've asked all the stablecoin companies in the space, right? And they're answering them. I'm getting on the phone with a lot of them, explaining the project, talking to them about stuff. And it really depends on your world perspective. So like, you talk to some of the guys and they'll say like, hey, look, I don't think the nation state's going anywhere. So one-to-one back to something like gold or fiat is excellent. It's going to make sense. Nothing else makes sense. It's cryptocurrencies. If they go away, we don't give a shit about that because we'll still be back to something that's real and whatnot. But if you stretch your mind and you believe in the whole entire cryptocurrency space and kind of some of the stuff I've been talking about, I think the model around seigniorage shares or collateralization to a degree, depending on if you get that right, is where we're going to. But my bet would be on a central bank for the internet will be the one that wins at some point in time.
Mm-hmm. So potentially using seigniorage as well?
Could be something like that.
Or pegged against something?
Or a way to smooth and flatten volatility. Yep. There's lots of different ways to look at it. And I think what you have to think about too with a lot of this stuff is you have massive amounts of capital coming into the space from some of the biggest and brightest minds in Silicon Valley, but you also have advisors from like traditional finance who are getting involved, like Myron Scholes from Black-Scholes model, Stanley Druckenmiller. Myron Scholes is an advisor to Saga. Stanley Druckenmiller invested in, I believe it was Basis. So they see value in a lot of these models and what they're trying to do as well. So, right now, a lot of the stuff, besides the ones that are backed one-to-one and centralized, are kind of experiments, and people are trying to figure out their models and how they're going to work. But the bet is that whichever one of those actually does work is going to capture a tremendous amount of market share.
Okay.
Yeah.
That's awesome, Georgie. That's absolutely incredible. Just some quick, short-fire questions. What's your view on the future of Ethereum right now?
I guess I'm contrarian compared to a lot of people, but I'm pretty bullish on it. I think like you'll see Plasma MVP come out in September, Casper, sharding, all those things are starting to happen. Again, it comes back to me that you have a committed amount of developers working on these problems. You have a big developer community building on it. Until you see a lot of projects flying away from it, or the things that they're trying to do just not working and stalling out, taking forever, I'd say that you shouldn't bet against it right now.
Gotcha.
Yep.
Any projects you really like right now?
Yeah, well, I advise a bunch of projects. So some of them are things like Crown League, Kadena, Lightstreams, and Good Money, and I like all of those projects a lot. So I won't say which ones I like more than others.
Sure.
I generally only work for companies that I actually believe in the value proposition there in one way or another. So those are some things that I'm really looking at and interested in. I'm also personally working on a project that is called Giora, and we will have more to talk about that going forward, but it's basically being spun out of AgriDigital, which is a supply chain company using blockchain technology. And this is a novel way of looking at how you can finance supply chains with a new level of financing and next level financing based off of blockchain tech. So
tell us, George, next 6 months, what do you reckon this whole space will look like in 6 months' time?
I think it won't look too much different in terms of tech being built out, good projects continuing with their heads down building, bad projects going away because they screwed themselves over, undercapitalized, or they scammed and left. But I think what will change is traditional money will start flowing more and more into it. You'll see more and more acquisitions in the space from traditional tech companies. You'll see more and more money managers coming in. And I would think, while I'm not predicting it all, I definitely think an ETF will come at some point. I don't know if it'll be 6 months or not, but I don't think it's too far off at all. And other sorts of traditional money tools that people are looking at.
All right. Let's talk about some current news, George. I'm keen to get your perspective on it as well. Bring me some news.
Can I put my sunglasses on for this?
Yes, the market's so bright right now. We're going to put shades back on.
That's right.
Trading trends. We got Square has announced that now you can buy cryptocurrency in every state.
Beautiful. I love it.
Isn't that incredible?
Yeah.
What do you think? What do you think, Georgie?
I think like I'm loving these solutions that are coming out. Like I used Robinhood from back in the day when it first came out, and like I logged into it the other day for the first time in I don't know years, and all of a sudden there wasn't just Bitcoin that they were trading. There's like Litecoin, there's Omise Go, like there's Lisk. They have about 20 different cryptocurrencies you can buy on there now. So like I love that stuff. I'm like any way that retail can get themselves involved in some way, shape, or form, you know, is always good to me. Especially if you know what you're doing anyway.
Crypterium is introducing a new way to transfer crypto faster via your mobile phone number. No addresses needed, just straight into your mobile phone. What do you think about that?
I like it.
It's fast.
Yeah, it's fast.
It goes back to your usability quadrant, right?
Usability is the main thing. How you can get people onboarded. I mean, make it easy for them to use this stuff.
Usability
It's so
is great.
clunky and shitty a lot of the times now that...
Facebook potentially bringing out its own blockchain. There is a recent exec of Facebook who was serving on the board of Coinbase has stepped down.
Yep.
Do you think that Facebook is going to buy Coinbase?
That's the rumors. I mean, people are saying that. It could be more hope than anything, but it would be interesting if they did. I mean, and really big for the space. Yeah.
Big stuff.
Yeah.
Could be possible. We got, and Bitmain is looking at AI. They just finished their $100 million pre-IPO funding round. Wow.
Yeah, massive.
Cryptocurrency mining. And it's reportedly planning to turn its sights to emerging areas like artificial intelligence, reportedly expecting the field to generate 40% of its revenue in the next 5 years. Which is quite incredible. I'm not sure how exactly that happens.
Massive.
But it's incredible. Bitmain's, it's apparently also got a huge stash of Bitcoin Cash worth $887 million. What do you think of Bitmain's stash of Bitcoin Cash? Stash of Bitcoin Cash.
Woo! Wow. I mean, that story has so much to it behind it. Like, lots of haters, lots of lovers, but like, it's massively controversial. People are saying that IPO is gonna fail. That Bitmain's overexposed. They've lost hundreds of millions of dollars trying to defend Bcash, and that's not in the disclosure statements. You know, I kind of tend to stay away from stuff like that in general. Like valuations like that scare the hell out of me. But it's just an interesting story because you know, it seems like even guys like that are getting margin called in this market. And that's something to think about. I mean,
definitely,
it's pretty wild.
Well, future's looking bright. We'll bring this bad boy to a close, guys. Thanks for tuning in.
Thanks
we
for
got a
having
question,
me.
Georgie.
Yeah,
we got a question, Joel. Brenda asked, "What did?" Oh, that was the previous question. Bring us another question, Joel. But in the meantime,
I've changed my mind on that answer.
In the meantime, I do want to talk about prices. Bitcoin is trading at 6246. Looks like
Rally Monkey.
Rally Monkey. Show us the Rally Monkey, Georgie. Yeah.
Let's put one up. Let's put one up here on the videotape.
Bring it up on the videotape. The Rally Monkey. Bring it back. There he is. Ethereum is up 11%. Ethereum Classic up 19% at $12.27. EOS up 11%, almost 12% at $4.78. Bitcoin Cash up 8.8%. Ripple is just flying. It's literally up 16%. Tron is up 23%, back over to 2 cents.
Short squeeze, in effect.
It's happening.
Yeah.
Bitcoin, Binance Coin is rocketing up as well at $10.18, up 12%. It seems like the market's coming back. Cardano is almost at 10 cents again, up 15%. Literally, look at this green. Like, I've got to wear shades.
I know.
George, it's seriously so bright.
I know.
It's future.
I know. My day's done already.
We're literally got to get a suntan out here.
Yeah, baby.
All right, guys, bring us the question, Joel, and then we'll bring this to a close. Question from our producer, Danny. What happens if crypto projects merge? Can tokens merge? With 1,600 altcoins, is token consolidation where projects complement each other in our future? Like, what do you think about the idea of a token takeover?
Yeah, look, I've read a lot about this, and it's super interesting. I think it's highly complex, and particularly, there was an article that talked about this, and you would have to almost do some kind of like hostile takeover type of mentality in one scenario. There's multiple scenarios to do it, but I think so. I think like at some point you have to start thinking about what are these projects going to do if they run out of cash and can't raise, or what if they are better off together instead of apart? Some things you might be able to do. The answer is yes. I think it'll happen, and I think some smart projects will probably start doing it within the next 6 months or so. But something else that projects might start to do, and you've already seen this happen once, is detokenize. So they realize that like, fuck, we raised money. We tried to make this token, but like we didn't really, our crypto economics were wrong. So we're going to give you equity in the company instead of a token because like people aren't actually using our platform.
Detokenization.
Right?
I love that idea.
Yeah.
I love that idea.
So I think you'll have token merging and detokenization at the same time.
Token mergers, token takeovers, and detokenization.
It'll be super interesting to see how like traditional or crypto investment banks put these deals together, because like it's going to take some innovative type of modeling and financial flows, and then the technology flow too of like how do you abandon a blockchain and all that stuff. So that's going to be super interesting. I'm actually excited to see how that works.
Yeah, I've got my popcorn ready. I've got my rally monkey. Guys, thanks so much for joining us. You can follow along with George on his website, semantics.com. And do tune in and read. He's got some incredible pieces of content he's written there, incredible papers. Thanks so much, Georgie, for coming in. Guys, subscribe.
Thanks for having me. It was a pleasure.
Yeah, it's always fun, Georgie. Do subscribe, guys, to the channel. Do follow us on Twitter, wherever you would like, Telegram, YouTube, Facebook, wherever you're tuning in from. And we'll see you tomorrow at the Daily Exchange.
And I hope we're still green.
Still green!